On this week's episode of The Capitalist Investor, I think we can all say that inflation isn't going away anytime soon. So today, we're going to talk about ways to navigate this inflationary market and ways to protect your wealth.
Hey, Tony, how's it going today?
Good, man. We are here in Cleveland. It's actually turning into summer. We went from 50 degrees to 80 within 3 days. It's awesome.
It was awesome. I don't think it's going to last, though, so that stinks.
Oh, man, stop it. Stop it, man. Positive energy. So talking about things about positive, inflationary has been very positive over the last several years. So today, I think it's a good thing to talk about inflation and how it impacts your life and your investments. So let's build a foundation and talk about why is it so stubborn. And I guess the one thing we can say is it all kicked off with COVID, right? Everything stopped being produced essentially and shipped, and people started buying things, creating less supply and more demand, and boom, now you got 9% inflation.
Yep.
But we can right now. So that type of inflation has come, gone, and it's not going away. Everything's stuck. We're not going to have a deflationary period. At least I hope we don't. Right? But we're stuck with all the inflated rates. Now it's going to start going back up. The way history has, maybe 1 to 3, 4% every single year, and we have to keep up with that now.
Yep.
But and I think in today's environment, you got a couple things that can help decide which way inflation does go or how fast it goes up. And one of them being the Fed decision. Are they helping or are they hurting? Right. So the Fed raised rates to curb inflation, stop growth, stop people buying things because interest rates were so low. Well, I think they've done a pretty good job with the soft landing. If you asked President Trump, I think you would have a different opinion. But cutting rates at this moment it can be inflationary because lower rates should stimulate growth. And with lower rates, it should encourage borrowing, spending, investments, things like that. And with all of those two things combined, it should spark a need for demand again.
Right.
Limit the supplies. Right. So it's gonna increase demand when there's no supply because the people are buying things, and that's good. I think that's one of the catalysts that President Trump needs in his one big beautiful bill is people to start spending money.
Yep.
And people can't buy houses at 7 or 8% interest rates. People can't buy cars when their interest rates are high single digits. They can, but it hurts the wallet. It hurts the pocketbook a little bit. So, what are your thoughts?
Yeah. So I think. We've obviously been talking about this now for a very long time, so it is a little bit nice to finally see some light at the end of the tunnel. I think during COVID and the aftermath, it's really pretty simple when you increase the money supply. So when you give away free money,
yes,
that is going to cause inflation, and that giving away those things and basically opening the spigots, there was a lot more aid or whatever you want to call it that was passed out besides those stimmy checks.
Right.
There's pauses on loans and just a whole laundry list of inflationary measures to quote unquote keep the economy going.
Right.
So it is nice to finally be able to say we're kind of on the downside of that, I think.
Yeah, it's just calming down, right? It's getting back to normal inflationary pressures of, again, 1 to 4% per year. But there are a couple other things causing inflation. And this is more maybe it's investment, but it's also personal. So think about energy. With this AI boom, they got to create all of these data centers that's going to be sucking up energy.
Yep.
And that's just for AI. What about energy is needed for food production, utilities, travel, like things that impact our lives on a day-to-day basis are also we got pressures there too, and it's part of the puzzle, right? And then we also have, again, I just feel like this is the new norm. We have to understand that, nothing's going to reset. We're not going to go back to 2022 prices. It's not going to happen. But again, I think we're back in a state where inflation is normalizing. Now I think, you can also just argue that now we need wage inflation to catch up.
Right.
People need to, make more money to buy all these fun things, right? All right. So point number 2. All right, now that we kind of set the baseline, where do you put your money? And, historic sectors that historically outperformed are energy, materials, and real estate. So I kind of have a idea on that too. And, we can also materials, but I can also call real assets like gold and commodities. So there's a lot to unpack there. But we just saw this the other day where, President Trump, said, he is the nuclear deal, right? And I think every nuclear stock jumped 10 to 30%. And then I had, some clients reach out and say, I want to get involved. Can we buy all these stocks? I'm like, well, if stock went up 40% in a day, we missed it. Don't buy it now. Right. But we have, in our portfolios, because we're actively managed, and we knew this was going to be the theme. Nuclear is a clean energy, and it's durable. It's proven. It's been around for over 50, 60 years. It's a good source, and it's clean. Now, the remnants of it, like the radioactive material, that's you got to get rid of that, right? And they find ways to, bury that stuff in the deserts and stuff. But nuclear, so we've been involved with Cameco, they're a uranium miner, and then also uranium, the ETF. We've been involved. We have that exposure. But the stocks that jumped 30, 40%, the one thing that I did, I was on Liz Clayman months and months ago, and I talked about uranium, and it's we like Cameco and we like the uranium ETF, because every other nuclear stock is so small that small companies come with high volatility.
Right. Exactly.
That's why you see a 40% pop in a day. I bet you they've retracted 10% from their highs, right? The other thing is now we have to think about cash positions. When we have this high inflation, stocks usually keep up. Dividend paying stocks, there's higher prices that we're paying on materials. We have higher revenues for these companies. And that means if they're a free cash flow type of company, that means they should be pushing out higher dividends to their stockholders. So being involved in dividend paying stocks in this environment could be greater than holding cash. Now, I know cash is cash where it pays 0.1%, but we do have money markets and treasuries that are yielding between 4 and 5% now.
Yep.
So you do have options, but 4 or 5% when the market is, done pretty well over the last few years, and still we're still predicting that the market should be, on a positive note by the end of this year, even with the pullbacks earlier this year. But these are places to put your money right now. And that's what we do. We have these, we have our dividend paying portfolios. We have exposure to uranium. One place that we had exposure but we eliminated was gold, because it's run up so much. It's so expensive. And I can't say that it won't continue, but it's in the stratosphere right now from where it has ever been historically. So those are one thing. What are your thoughts, Steve?
Yeah, I think really the cash and the fixed income market too has kind of been it's nice to get a higher yield on your cash savings, but I think what we've given up for that is an extremely volatile bond market over the last 3-4 years. And that's an area we're used to, just kind of getting 6 to 8% return and not even thinking about it. With the increased inflation come costs as well, and the bond market has certainly been, turbulence probably the wrong word, but just not yielding what we are used to having it yield.
Yeah, well, I mean, you would think a positive catalyst for bonds would be, the Fed lowering interest rates.
Right.
You would think that would be happening, and yields have been popping already. But now the one other thing I did mention is, like, historically real estate has been one of the best performers over a long period of time, especially since COVID. I think everyone's house has, gone up 30 to 100% value, whatever, think about that, right? My argument, I've said this multiple times throughout different episodes, but real estate might be one of those assets in this inflationary time that actually see a pullback in real estate prices. And I'm talking like personal real estate, homes and things, not commercial and real, things like that. But I'm talking that because right now, everyone that has a 3% interest rate locked in, they're not moving. And I don't feel that anyone's going to really start thinking about selling their house that has a 3% mortgage until rates get to that between 5 and 6%.
Right.
And we're hovering around 7. So the only way for that to really come down, and again, President Trump's been pounding on the Fed, specifically Powell, to lower interest rates because he wants to stimulate the real estate market. But there's no supply. But there's still demand. And when you start lowering interest rates and now people start relinquishing their 3% mortgages because they can get a 5, they can swallow that pill and say, okay, I'm okay spending more money on the mortgage or whatever. That's going to be the catalyst to create supply. And now when there's more houses on the market, I would assume that the prices would come down. This is the one time where I feel we could see a pullback in home prices.
Yeah, I completely agree with that, and I think we're actually starting to see that a little bit. We're starting to get news and reports about actually some supply coming back into the market, kind of a more sellers than buyers type of situation. Really, because of what you just said, there's just. You would have to be crazy to if you had a 3% mortgage to sell your house and then take on more debt than you have right now at 7%.
Right.
That's just going to be
your payment's going to more than double.
Yeah, more than double.
I don't think many people are going to do that.
No. Yeah. So you have to have money to burn, or you have to be in a situation where you have to move. Right. Exactly. That's pretty much what's going on in the real estate market today. So, so I think. We talked about this before, and it is kind of, one of my big points here. We're not going to be able to tax and save our way out of this current mess that we're in with the deficit. We're going to have to stimulate the economy, and we're going to have to produce more, and we're going to have to raise GDP.
Man, as a sidebar, how upset is Elon about the how piggish the new bill is?
Well, he's right. That's the low-hanging fruit that the public wants to see get taken care of.
Yeah, and he looked at Trump's bill and said, "What do you? Yeah, this is not what I spent the last 3 months of my life trying to find
working 24/7,
right? Trying to find areas to save money, and you put this bill out there. So I wonder how their relationship is going to turn out. So." And you know what? I give Elon some credit on this. I know this is a huge sidebar, but I give him some credit where he's a realist. Like again, you can go on both sides of the aisle. You should be able to, right? And Elon used to be on the left side, and now he's more on right of center, kind of like our views. But there's things that he'll go back and be like, this doesn't make sense. It does make sense to cut these, and so. I give him a lot of credit for not just falling, quote unquote, falling in line. He's voicing his opinion, and he's right.
Yep,
he's right. So, all right, how do we stay calm in this emotional investing, right? Because inflation can scare a lot of people. And one thing I will say is that we have survived high inflation in the past. and we will survive and thrive going forward. So first and foremost is time in the market is greater than timing the market. You have to stay involved, right? Building, we need to be able to build an investment theme that is actively managed right now, because it's very important, because President Trump constantly is communicating and creates volatility that goes with it. And I'll even say he's highly active on communicating. and it just throws a wrench in a lot of sometimes long-term investment strategies.
Yeah.
I want to tell everyone to stay long-term, and you should, but there are some things where, you'll have your long-term investments, but there might be some short-term based on what is going on. So we need to keep that in mind. And your thoughts on that, Derek?
Yeah, I mean, we say it over and over again, but that's because it's true. It's just going to be extremely volatile until some official trade deals get put into place.
Yeah, and the tax bill is locked in too.
Yeah. I tell everyone I talk to this, and you said it clearly last week. It's that tax bill getting passed and implemented is priced into the market.
Yes.
So if there is trouble there, you're going to see a massive. Well, I don't want to say but you're going to see a big pullback.
You're going to see
10% ish.
Yeah, you're going to see a pullback. I can't determine how much or how little, but it's priced in. I mean, honestly, the market could pull back once it's passed because it's sell the news.
Yep, that will happen probably.
Right? Like that's definitely on the table too. But to kind of wrap this up is inflation. We know has risen quite a bit in the last 3-4 years since COVID, right? But so should your portfolio should have too. And if you got uninvolved and you sat in cash, you missed it. And that's why emotional investing is really detrimental over a long period of time. And you have to stay the course. You have to stay involved. Now, can you change your strategy? Sure. Right? But you have to pick a lane. You can't flip-flop either. Right? You gotta make an educated decision on where you think things are going, and stick to that, because you can always change it. But the flip-flopping, when people flip-flop, it's because they're chasing something they missed.
Right.
And that's a big problem.
For sure. Yep. So, stay the course, get an investment thesis together, and stick to it, because it's in these volatile markets, in these markets that are reacting to news in real time. It's going to be volatile. So if you have a much bigger chance of magnifying mistakes if you're in there, trying to time things, because quite frankly, if you're trying to time things right now, you're guessing, because you don't really have, a solid idea of what's coming tomorrow, as far as news is concerned. So, stay the course, get a plan together, and make sure you execute it.
Yep. I agree, man. So, all right, take us home, brother.
All right. Well, thanks as always for listening this week. If you guys have any questions, comments, show ideas, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.